Today we're going to talk about FICO scores and your credit report. Now your FICO score, your credit score, is determined by 5 different factors. Number 1 is going to be your payment history with all your accounts. Now number 2 is your capacity of credit. What that means is how much credit do you have available to you. That's why when people have their credit cards maxed out, their credit scores go down because they don't have any credit available to them. This also applies for people that pay off all their credit cards but then close their accounts. This is detrimental to your credit because then you don't have anything available to you. Number 3 is going to be the length of those credit accounts that you have, both houses, cars, credit cards. Number 4 is your new credit. This is typically your accounts that you've established between the last 12 and 18 months. Number 5 is your mixed debt. This is your installment debt and also your revolving debt. Now installment loans versus revolving debt are like maybe a car or house versus your credit cards. Now you might have heard from a family or a friend, maybe a coworker, that if you get your credit pulled by a mortgage company, your credit score is going to go down, it's going to hurt your credit, and that's absolutely not the case. Now when you're applying for a mortgage loan here at Summit Funding, we're only going to pull your credit one time. That's completely different than if you were to go apply for, say, 3 or 4 credit cards. The FICO system looks at that as you're trying to get yourself into debt, and revolving debt isn't viewed in the same light that a mortgage debt is. Remember, if you have any questions or you need any help, please feel free to reach out to either myself or anybody on my team.